So Danny said I'm Kat, I'm an audit partner here at Parry, and I also lead some of our technical advisory projects. So we've got, there we go. So today we're going to talk to you a bit about what's happening in the accounting framework, so in UK GAAP, so FRED 82 and FRED 84. And then we'll go on to talk about what's happening in corporate reporting and the themes that we're seeing there. We're then going to have a bit of an auditing update because, interestingly, we got some feedback last time that some of you want to hear more about what's going on in the audit world. And I'll be honest, that surprised me because I think there's a few ex-auditors in here that I thought would never want to hear about audit ever again. But by popular demand, we're going to talk about auditing standards. So you asked for this, just bear in mind. And Economic Crime and Transparency Act sounds really sexy. No, it's called Companies House Reform. Not as good as it sounds there, economic crime. And then fraud. We'll touch on what we're seeing in the world of our audit clients at the moment in terms of fraud risk. So firstly, FRED 82. So those of you who've been here before will have heard me go into quite a lot of detail because I do love the upcoming changes on UK GAAP, particularly in leasing. And we've been talking about this for quite a while. The government has done whatever it can to kick this into the long grass. So it's been in the coming for a long time. And there was a comments period that ended earlier in the year. They got all the comments in and thought, yeah, we need to still do some more work on this. So it's been delayed again. So it's now effective for accounting periods commencing from the January 26th, so December 26th year ends. So we've had another delay on the changes to UK GAAP, which we'll go on to. So I'm not going to go through the substance of them in lots of detail because we don't know quite what it's going to look like again. But we will do that in later sessions and we'll be putting detailed workshops on and all the rest of it when it does come on, because these are some quite far-reaching changes. So the two changes, just to remind you, are to harmonise with international financial reporting standards. So any of you in here do adopt IFRS, you'll be feeling pretty smug because you already know what these are and you're already doing them. So revenue is a big one, and that's to align with the 5-step model that you see in IFRS. So we're moving away from the UK GAAP more judgmental risks and rewards model to one that is a very prescribed 5-step model. We're moving to performance obligations, fair value of consideration, all that lovely stuff that is in IFRS. And UK GAAP is bringing that in. And how much that impacts you will really vary depending on what industry you're in, how complex your business is. But even retailers, I would have thought, wouldn't have impacted because you buy it, you sell it. They do if you've got loyalty cards, gift cards, point schemes. So the devil is in the detail. And when we see what that standards looks like, it's worthwhile looking at the impact assessment on you. The leasing one, which is my baby, is a lot more involved because what that is doing is bringing all of those operating leases you've got, so your head office lease, if you've got stores or gyms or pubs or cars on lease, all of those numbers that go into a fairly chunky note at the back that no one really looks at, they will now move onto your balance sheet. So that will move on to your liabilities as a lease liability and into your fixed assets as a right of use asset. So even though they net off pretty much, unless you've got time in, they will still be two of the biggest numbers on your balance sheet and will replace rent that goes through your admin expenses with depreciation and interest charge. So your EBITDA will shoot up, your gearing ratio might be affected, your interest cover might be affected, and you'll also have a big operational impact if you're a retailer or a multi-site operator or have a lot of car leases of actually collating all this data, digging out the leases in some cases because they might be years old, gathering this all, getting an appropriate discount factor. Some people have special softwares. You might have to have specialist teams to implement it depending on the size of your business. The leasing one is quite involved in some cases. If you've just got a property lease, it might not be, but they're chunky numbers and it's important we get those right. Other changes in FRS 102 coming up are really just to make some of the encouraged disclosures mandatory. So most of you will be doing this already. So things like going concern, most people do have a going concern note, but it's making sure that that's a must have rather than a should have. And the rest of it really is just to align with IFRS. So a lot of the IFRS wordings and terminology and concepts are now being embedded into FRS 102. Things like, for example, IFRS contains the prudence concept and UK GAAP didn't explicitly. It's things like harmonising things like that again. And the substance of all this when it comes in, and don't quote me on page numbers, but it was like 200 pages for UK GAAP when it first came out. The changes alone are about 400 pages. So you can see we're heading to a lot chunkier piece of accounting framework now that is more aligned to international standards. So the feedback they had, and if you're a geek, it's worth reading some of these because they're quite interesting, but they were quite far-ranging. So as a result, they said we're now going to revisit the standards and we're going to publish guidance in H1 2024. We've put maybe because they've missed every deadline they've ever set themselves. So it's still yet to be seen when they'll publish the final version and whether that will go to consultation again. So that will be at least 12 months before the effective date. So as soon as we've got the final version, we'll let you know and we'll put dates in for training because it's important you get prepared on these. They can have a real big impact. The feedback was IFRS 15, the revenue, most people want it to be more closely aligned with IFRS, which surprised me. So the feedback was like, yeah, we like it, but if we're going to do it, let's go whole hog and align the two. The feedback on leasing was a lot more mixed, and they were saying it's out of proportion, it's still too complicated, can we have more exemption reliefs? And that's one where they are now looking into how they treat that, which I mean, I do think it is disproportionate for a lot of small businesses, but we'd still end up with a two-tier system, which is not what this was intended to achieve. So watch this space on the differences there, but yeah, they're still on the horizon. FRED 84 is a bit dull, I'm not going to lie, because it's very niche. It's really about supplier finance. So what this means is we're seeing more where, like we can spread payments and Klarna, that businesses are using that for big purchases. Insurance is a really common one you see where you can spread the payments on things like that. The supplier finance standard is saying where you do this, we want to see more disclosures. So it's to harmonise again with IFRS, and it's saying we need more disclosures on where you have supplier finance. We want basically 2 trade payables note, one that is the non-financed purchases and one that is the finance purchases. Not a lot more to say on that one, and that one is effective for December 25 year ends. It's still in consultation, but it's quite non-controversial and it's very much aligned with IFRS, so I think it will go through as proposed. Right, moving on to the annual review of corporate reporting. So the Financial Reporting Council every year select a number of companies to review, and I think there's some people in this room that have probably been subject to one of those reviews before. They're not nice. And they will, this year they reviewed 250 companies, mainly FTSE 100, 350s and AIM, but also some large privately owned businesses. And of that, they wrote to about 120 to say, can you just explain this to me, or can you talk me through this? And as a result, a third of those had to be restated, which felt like quite a high proportion, to be honest. But actually, if you look in the small print, it's mainly restating the cash flow statements and getting those presentations right. So it's not as bad as it first sounds, but yeah, they do really go into the detail and challenge where companies need to restate. And the themes they raise are no surprises here really, but the first one, impairment of assets, has really jumped up the leaderboard, and I think that's because of the volatility we're seeing. So again, this is mainly international reporters who are required to put the detail in there anyway, but they're saying we want the detail. So it's not enough to say we've assessed impairment looking at forward-looking projections or historical data. They want to know what percentages you're looking at, what's your headroom, what's your sensitivity, what sales forecast targets have you put in there, what discount rates have you used. They want detail, especially if there's not a lot of headroom on those impairment calculations. They really want you to explain that. And that's the same, I think, on all of them really. That's the theme, that they want more detail. So judgments and estimates. They don't just want to say you've used management judgment, or what judgment, what percentages, what forecasts. And that covers quite a few of them, to be honest. Cash flow statements we've talked about. Their main beef there is that no one gets the presentations right. So where things sit, is it a financing cash flow or an operating cash flow or an investing cash flow, making sure they're in the right categories. The treatment of non-cash changes and how we offset some of those cash flow statements. It's one that I can't get too excited about, to be honest, but obviously the FRC really do. So that's a big focus for them. Strategic reports, they always raise. They don't like the glossy style reporting. They want it to be balanced. They want the bad as well as the good. So that's the main point there, is that they want to know about what else not happened. Or if it's been a poor year, please tell us why, and not just make it kind of a glossy brochure style report. So fair and balanced is the message on that one. Financial instruments, again, is more disclosure about things like credit risk, liquidity risk, market risk, make it bespoke to the business, not boilerplate. revenue saying not boilerplate. They want everything bespoke, tailored, more detail. And then the last one really to raise is income taxes. So deferred tax comes up every year. I think no one understands deferred tax if they're honest with themselves. And that's what the FRC is saying. Where you've got deferred tax assets for losses, they want to know when they'll be recoverable, why you think they're recoverable, the assumptions around it. And that proof of tax notes, I'm looking at Adele and Mark, they said they need more detail. That's their view on that. That note where you reconcile what your tax is predicted to be to what it actually is, they want more detail about the reconciling items there. And again, that's obviously a last minute note that goes in. No, they want more thought through that one. So they're the themes. And these are for the larger businesses, but they will trickle down, and that's what your auditors will start to be looking into. Auditing standards, and moving on to the highlight of the morning. So there's a couple that have recently happened that I just want to talk to you about. So your audit partners will already have spoken to you about these. These will be December 22 year end, so you might have already gone through an audit cycle with them in. If you haven't, you're behind on reporting, no judgment, but I'll just talk you through what those changes mean, and then that will set the scene for the auditing changes coming up too. So we have had a bit of a period of change in audit. ISO 315 in particular has necessitated a lot of training. We've had to redesign caseware, the software's changed, there's a lot more spreadsheets and checklists and all the rest of it. So just to set the scene on that one, they've all got snappy titles, but this one's basically the risk standard. And for those of you in audit will remember we used to talk a lot about risk, and now we have to talk about it even more and in more detail with new words. So it makes us specifically consider inherent versus control risk. We have new terminology to talk about risk, subjectivity, complexity, certainty. We have to assess risks separately. We have a new spectrum of risks. So before, you might remember you'd have low, medium and high. Well, that's not enough now. We need a 5 or a 10 spectrum of how we assess risks on a continuum. We have to obtain sufficient evidence at the planning to support that. So it's not sufficient to say, we think this is a risk, we'll pick it up at the year end. No, we have to be involved in that at the planning stage. So what you'll see on this is more documentation around IT controls in particular, IT systems. We might have asked to speak to IT teams, we might have asked you to fill in checklists. This is all part of our planning procedures, and planning has got like a whole world in itself, basically. And then there's a stand back requirement that we have now. So we can't just say we think revenue's a risk and we think it's stock and we're not bothered about the rest. We have to go down every material balance and justify why we are or are not including that as a risk. So you can see the planning sections have got quite chunky as a result of this one. This is the one I think we've felt the most impact of as a team. And then 240, which is the fraud standard. Again, linked to that, risk assessment approach and changing how we think and talk about fraud risk. So it's clarifying the objectives of the audits and that what we're meant to do for fraud, what our expectations are. We now have to do more work around ensuring professional skepticism, making sure we're not biased. So before we used to perhaps look at where there had been frauds historically and leave it at that. No, now we have to have a more kind of open mind to where could it occur, how could it occur, have we got disgruntled employees, have we got bonus schemes or share options or anything that might incentivise someone? Are there any areas coming out of the ISO 315 where controls probably aren't as good? Do we know about frauds happening in other businesses that could apply here? So we have to be more sceptical in the meetings that we have internally to where could it happen in this business, taking aside what we know about someone and what our judgment are, have that open mind to that. So a lot more of our internal chats about fraud. We'll also be asking you more chats about fraud. So are you aware of any instances, any suspicions? And then same to you, where do you think it could happen in your business? Where do you think your biggest gaps are or your biggest weaknesses? It mentions ISO 550 related parties because that is identified as where management have the chance to perhaps commit fraud or manipulate records. So now we have to understand all related parties. So if we're asking about wives and children, it's not just because we're nosy buggers, it's because we have to know this data, because we have to be looking out for names and that sort of thing. So yeah, that's just to set why we have to ask these questions now. We're required to be aware of everything, even if it is a toddler, we have to record these things on our file. And they're the ones that have happened. So the ones that are coming in, 220, so your audit partners might have spoke to you about this. I kind of see this one as the audit partner standard, because what this one is doing is clarifying the role of the engagement partner. And the partner is not necessarily a partner, it might be a director, it's your signatory of your audit. And it's enhancing the role and clarifying their role. So what this one is doing is really making it clear that the person who signs your audit opinion is responsible for the whole audit. And that's resource. So if I have concerns that there's not sufficient time allocated, I can't say, well, yeah, that's the HR team sort that. No, I have to be seen to have challenged that and done what we can to make sure we've got sufficient quality, or spoke to clients about deadlines or whatever it might be. It's about role modelling across the team, especially on professional scepticism. So I have to be there going, no, are we showing groupthink on this? Or I think that's collective bias. You know, I have to be seen to be role modelling a very sceptical approach. It talks about sufficient and appropriate involvement. So when the audit partner is expected to get involved, how much time they're expected to spend on it, what they're expected to sign off. I have to consider ethical requirements, so sign off any non-audit services. When we accept a client relationship, be responsible for signing all of that. So all stuff we've done in the past, but really it's the documentation of that that's really increased. So you'll be seeing a theme here about documentation. So yeah, this is the one I think Danny, us as audit partners, really feel the pressure of, really. Mm-hmm. It's very much clarifying our role on that audit. And then the last one is ISO 600, which is group audits. This one is effective the year after. It's again linked to the other two. It's all about risks and enhancing quality. The main differences you might feel there are we've got rid of some of the terminology we've had in the past about significant components and some of the 10% of this and 15% of that to a more risk-based approach. So we now have to consider all components on a risk-based spectrum. And we have to have better, robust two-way communication with component auditors or group auditors. So we can't just send them instructions and then get them back and put them on file. We've got to be seen and documenting that we're having a robust challenge of their work and their findings. Again, requirements on professional scepticism, and again, documentation. So when I started in audit, I don't know if it's the same as you, used to have the little trolleys with the audit files and you felt like you're on The Apprentice. Like, we couldn't do that anymore because it'd be like reams and reams of paper. So most of this is real documentation push to get the quality of audit files stronger and therefore the quality of our opinions stronger. So hopefully that's helpful just to set the scene of what we are seeing and then how that might translate to what you get asked to do. So it might be more conversations, more meetings, more checklists, more work on IT, more fees in some cases. So yeah, I thought it was useful to set that scene. And that's it currently. We're not expecting anything else. There is one mumbling about sampling. So there's no changes imminent, but the FRC and the QAD, the Institute of Chartered Accountants, are making noises that they don't really like capped sample size methodologies, which most of the industry have, apart from Big Four. So we do think that the direction of travel is that that might get challenged in future years. If any of you are audited by Big Four and have uncapped sample sizes, you'll know how painful they can be. But it's definitely a repeated comment that keeps coming up in their thematic reviews, so we're expecting to see some pressure on sample sizes in the future. So the Economic Crime Act. So this one, again, you might remember me talking about it. It's been mumbling on for a while. And the backstory to it was, you might remember a few years ago, the government were on a big simplification kick. We're getting rid of red tape. We're not making you fill in all these annual returns and all this anymore. Just tell us who the PSC is and that'll do it. And that's how we went for a few years. And then they realised that they didn't really know who owned any UK businesses anymore because they'd stopped asking for that information. And when the Russia-Ukraine war came in and you were told, don't work with businesses with this or we're sanctioning these, you realise, well, you don't even know who owns half of these businesses because they're not required to report it. So these regulations are bringing back in some of the changes that they simplified in previous years. So we're kind of going backwards a little bit on some of this. And it's had a long journey through Parliament. It's reached royal assent. So it's now law. So it is technically effective. But as we'll come on to, they need to actually put resources and software changes and all the rest of it. So we'll get to see how practically some of this will be implemented. Yeah, so there's the kind of story of how it started to kind of come back in and where we are. Like I say, the Ukraine, there's some interesting books about this and like mafia and how London has got a lot more Russian money in than we realised and know, and still to this day, this is why some of this is coming back in. So it's an interesting tale of peddling back, I think, by the government. So Companies House are increasing the remit of their powers, and that's kind of the gist of what they're aiming to do. What that means is they've got powers now to query information. We don't know what that looks like, but if any of you have had the joy of having your accounts rejected because you've got the wrong number on like page 7, it's a delight. So we don't know what querying means, whether they'll be actually just looking for compliance or whether they'll be going into the detail of accounts. We don't know. But yeah, querying information powers. Stronger name checks, that's to stop businesses setting up with like a very similar name to an actual business, perhaps where they're committing fraud. So they'll be able to challenge what names you've got as a business. Registered office can no longer be a PO box, it's got to be an actual verified address. Company email address is the same. The lawful purpose confirmation made me laugh a little bit because they want all businesses to sign annually when you set up a business that the business is only for lawful purposes. But if you're a criminal, your probably morals and ethics are a little bit off anyway, so you probably don't care about signing. It doesn't hit you in the heart to sign that checklist, but yeah, you've all got to sign a lawful purpose confirmation going forwards. A lot more powers about data cleansing, data sharing, make sure Companies House information's up to date. But we don't know when that will come in because they need software and resources to do it. Anecdotally, it is worth adding, Companies House are getting a lot more aggressive. So I'm seeing some of my clients who are not that overdue, and they are starting prosecution against directors to get records up to date. You can kind of head them off with correspondence with lawyers and things like that, but we're seeing it from 3 months overdue, which can happen in some cases if you've got something going on, it's a bad time for the business. They are a lot tighter on clamping down when things are late and getting some very aggressive paperwork, which is quite scary for a director. Changes coming down the line. So one of them is simplified accounts filing. So before we spoke about that to take some of the exemptions that small companies take, like not filing a P&L or claiming to be dormant or some of those filleted accounts, they're reliant on you being small, which is often a virtue of your turnover. But if you don't file your turnover, how do Companies House know that you're entitled to the exemption you're claiming? So to start with, they said, well, we'll just get away with the whole thing and everybody will have to file full accounts. So that's a big change for small businesses because they perhaps never previously had to file some of this information, so commercially sensitive to some. What they have said, this is in the law, but there's a small piece in the paragraph that gives the Secretary of State the right to amend it. And what that means is they might request that you share it with Companies House, who'll then look at it and go, oh yeah, you can take the exemption, and they will file it without that information. But again, they might just say, well, actually, we'll just file the lot, it's easier. So they don't know yet how that will be implemented, but it is in the small print that they could have some relief on that to not file P&Ls going forwards. Dormant company confirmation, again, not that controversial. They want you to sign every year if you're a dormant company that you are a dormant company. Obviously, you are a dormant company, otherwise you'll be filing dormant company, so that's like an exercise in nothing, really. Accounting period shortening loophole. I think there's a few of us who've used this a lot, and it's been very useful when things happen and we need a bit more time to file the accounts. They're closing it, sadly, so we don't know when, but there used to be a trick where you still use it now, so until they close it. If you shorten your year end by a day, the day before your filing deadline, you automatically get 3 months without penalty to file. So it's a good one to know, but no, they've got wise to it and they're getting rid. And then the last one is ID checks. So if you file anything on Companies House as a director, you will have to verify that you are who you say you are. So same as doing your tax return, it'll want to know, put your passport in, what's your mortgage payment, all the rest of it. It's one of those government ID checks. A few other bits in there, but yeah, that's the bulk of it. And again, we don't know when it will be implemented. Fraud update, so last bit. So this is not technical guidance, just thought it was useful to share what we're seeing as auditors and within our clients. We are seeing a lot more fraud. So in virtually all of our clients are experiencing some challenge here, greater sophistication. So I thought it'd be useful just to have a bit of a recap on that. So I'm only working in retail, so most of my clients are sophisticated, and I thought, actually, they're going to be the targets. They've got this customer data, they've got this credit card information. They're not. The targets are traditional manufacturing businesses, historic businesses, ones that you wouldn't think would be a target, but they are because they've often got legacy systems, they're often patched up and not supported, not on the cloud, not the most sophisticated. They might have trade secrets. They might have big payments going out. So most of the fraud we're seeing tends to be in those kind of businesses, which is not what you would necessarily expect. There was one, I think, it's not one of ours, but Knights of Old, they're a logistics company, and they've actually went bust. I think 700 people lost their jobs because they got a ransomware attack and they couldn't recover the data. So that was the end of them. So it's be vigilant, especially in industries you wouldn't expect, like no one's going to target us. Well, they are. And where they tend to be targeted at the moment, we're saying about this the other week, with all these new terms like phishing, vishing, smishing, there are all these different ways of doing it. So it's useful to kind of perhaps be educated of what's out there so you're aware. But some of them are really sophisticated. So one client they were negotiating a new piece of kit, and the fraudster embedded in the chat, in the email chat, a real life email chat, for about 3 months. They were talking about this machine and like spec and blueprints and all the rest of it. And they were talking with the property procurement team and everyone. It wasn't just a quick in and out, it was a real layered fraud. And they went to make the payment. I think it was a Chinese supplier, so it was a long name. And they changed, I think, one letter on the email. It was like an O to a 0 or a J to an I, something very small. And it was fraud. And the bank flagged it. The bank did are you sure this is not a scam? But you get those all the time these days. So the FD were like, oh yeah, it's fine. But no, it wasn't. And it was a fraud. And I think it was 140,000 win, something like that. So how long it had been going on was the challenge. And again, the controls of, before you make a big payment, perhaps look at, do you have a Zoom call or do you ring them and confirm details? All the rest of it was some of those controls that had gone by the wayside. And again, that bit about the bank check-in. I don't know where they got to in the end, but I think the bank were a bit unwilling to pay out because they had flagged it as a potential fraud. But the client were like, yeah, I get that on everything these days. So that was one. There was another one that was really like Black Mirror because we don't know if it was AI, like voice technology, or if they'd actually spoken to the other person and recorded their voice. But anyway, someone rang, their contact says it's definitely legit, and it sounded like them, but it wasn't them. And we think that was a deep fake voice message. Is that vishing, you said, if it's...
Yeah, vishing, the use of the voice
to,
fraud.
Yeah.
Fraud, as opposed to email, which is phishing.
Yeah.
Smishing is social media.
Smishing is social media. So apparently, most phishing emails I read, 80% of phishing emails are LinkedIn. So that's a really common one to look out for. So yeah, some really kind of scary stuff going on, ransomware and all the rest of it, and very sophisticated. So really make sure you're protected as a business. I think you can get cyber insurance, but it's increasingly hard to get, increasingly expensive. Some businesses use ethical hackers who will come in and hack your systems to tell you where the gaps are. You can have internal phishing emails. We get a lot of these at Parry where the tech team will phish us, and then if anyone clicks on it, they're like, you've got to go on the training, mate, you've just clicked on a dodgy one. Mark, you were saying most of your life at HSBC was sent on.
Tons of them.
Lots of them. And we have training regularly, not just once a year, it's repeated throughout the year, like bite-sized chunks. And the bit of advice that I thought was really useful was treat this as a live instant critical response, same as you would if your building was on fire. Plan for that business continuity emergency moment of, shit, we're being hacked, what's happening, what do we do? Are we going to pay a ransom? You need to decide that as a board before it happens, and you might need to have the funds available to do it. Because some of these ransoms are not actually that much. I think the same British Library is currently being held to ransom for 600 grand, but it's all the cost of the software consultants to maybe get access to your systems afterwards is where the funds. But you need to decide, what's our policy on this? Can we get access to it if we need to do it? What are we going to tell our customers? What are we going to tell our staff? What do we do about our other systems? Have we got a backup procedure or an emergency procedure? So basically treating it as if you've got a fire, treat a hack, what would your response be? And it's not just something to put in a drawer, this is a real business critical moment when it happens. I think that's everything I've got to tell you on fraud. So I think that's it from me. I'll be around for Q&A after, and over to Mika.